IRR is the short form for internal rate of return. In very plain and simple words, it is the growth rate of an investment. The rate at which your investment grows is nothing but the returns you earn from that investment. So the terms rate of growth, rate of return, or even rate of interest can be used interchangeably. But the term can get a little more specific by calling it average annual compounded growth rate. I know it sounds very similar to CAGR, which is compounded annual growth rate. In fact, they are quite similar, and the method of calculating IRR can be used to calculate CAGR as well. But please note that in this video, I will only be discussing the concept of IRR and not the method of calculation. That is covered in a separate video which is linked in the description. Now let's explore this explanation with the help of a few examples. Assume you have given a loan of 10,000 rupees to your friend. After a year, he returns 11,000 along with interest. What is the returns you got on your money in percentage terms? How can we calculate that? You got back 11,000, which was 1,000 rupees more than what you paid. This profit of 1,000 on top of the initial value of 10,000 is 10%. So 10% is the rate of return for you on the loan you gave. Another way to look at it is that the money that you gave grew by 10% over a year while it was with your friend, and then he returned it. So you can also call it rate of growth. This growth of 10% is nothing but the internal rate of returns for you. Now let's consider a slightly more complex example. Let's say your friend couldn't return the money after a year. Instead, he paid 12,000 rupees after 2 years. Now what is the rate of return? 20%? Yes, 20% is the total or absolute growth. But what if we want to know the growth rate per annum? 10%? We can check if this 10% is the correct answer by calculating. Let's start with the 10,000 that you gave. So if this amount grew at 10%, it would become 11,000 after a year. In the second year, it should grow by another 10%. Now the amount with your friend is 11,000 including the growth, and hence 10% growth should be taken on the 11,000, which will work out to 1100. Adding this would make it 12,100. So if your money grew at 10% per annum, you should have been getting back 12,100 after 2 years. But you didn't. You got only 12,000. Which means that you actually got less than 10% per annum. In fact, the correct answer is 9.55%. How exactly did we get this number? We will cover in the other calculation video. But for now, let's just try to verify this number. With 9.55% growth, the 10,000 will become 10,955 at the end of first year. And 9.55% on this 10,955 will be 1,045. Adding this will total up to 12,000. So 20% in 2 years is not equal to 10% per year, but rather 9.55% per year. The reason why it is 9.55% and not 10% is because of the effect of compounding. When you're compounding the growth or taking compound interest, you should always apply the growth on the amount at the end of each interval and not the original amount. In real world, all financial institutions consider only compound interest for all sort of transactions. We never take simple interest. And in the IRR concept also, we always assume that the growth is compounded. So the annual compounded growth rate of your money in the example is 9.55%, which is nothing but the IRR. So we have expanded our understanding from growth rate to annual compounded growth rate. Now let's move on to one final example. Imagine you invested 10,000 rupees in the stock market. You bought 10 shares of a company at 1,000 rupees each. Now the share price is going up and down over the years. After 1 year, the share price went up by 10% and reached 1100. You sold 1 share at this price and kept the remaining 9 shares. Second year, the shares fell by approximately 27% to reach 800, and again you sold 1 share. This time you ended up with a loss of 200 rupees or 20% on your original investment. Third year again, you sold a share for 1200, and in the fourth year, you sold the remaining 7 shares at 1250. Now what is the average returns you got from these transactions? One way a lot of people might try to calculate this is by taking the growth rate in the share price each year and taking its average. That will come to 9%, and that's an absolutely incorrect method. Some people may also calculate it this way, that you invested 10,000 and got back 11,850. So the total profit is 1,850, which is 18.5% in 4 years. So per year it must be divided by 4, which is approximately 4.6% per annum. This is also wrong, because we would be making the same mistake as thinking 20% in 2 years is the same as 10% per annum, which we saw in the second example. The only way you can get the average return per annum in this case is by calculating the IRR, because IRR will take all the different cash flows and different growth rates in each of the years and return to you one average number which is representative of the growth over the years. The average growth in this case is 5.03%. What do I mean when I say the average growth is 5.03%? It means if you invested your money in some place where they gave you a constant return of 5.03% every year, you would have ended up with the same amount of money as this. Let's give this calculation also a try so that you can see how the numbers match up. Once again, let's imagine you invested this 10,000 but in a bank who will give 5.03% fixed interest. At the end of the first year, you will get an interest of 503 rupees and the amount will become 10,503. Now you withdrew 1100. Why 1100? Because we are trying to recreate the same pattern of cash flows you got by selling shares in the previous example. So after this withdrawal, you will be left with 9,403. Next year again, this money will grow at 5.03% and become 9,875, and withdrawal in the second year is 800. If this continues in the same pattern, at the end of fourth year, you will be left with exactly the same amount of 8,750 rupees. The point of this example was to show that the cash flows from the share business is exactly the same as investing your money at a fixed rate of 5.03% per annum. Which means that when you sold the shares in the example we discussed, it is as though the money you had invested was growing internally at a constant rate of 5.03% every year. That's why it's called internal rate of return. What you actually got each year might have been a different amount. If you take each year's profit or loss, it's a different percentage. Even the year-on-year share price movement was completely different. But the average return was 5.03%, which you will get when you calculate the IRR. So to summarize, IRR is the rate of growth. It can also be called rate of returns or rate of interest you earn. IRR is always compound interest or compound growth and never simple interest or simple growth. IRR is the per annum growth and not the total growth. And finally, IRR is the average growth, which means that even though the real growth may be different each year, we will find an equivalent single number which will amount to the same total growth. With this, I hope you are clear with what IRR is as a concept. But if you are a finance student or check any finance textbooks, you will often come across another definition of IRR which says that IRR is the discount rate at which NPV is equal to 0. This is a more complicated way of looking at the same thing. If you are confused by this explanation and are looking for more clarity on that, I have made another video in which I will mathematically show you how that definition is same as the growth rate explanation. You can check the link in the description. And if you are interested in learning how to calculate IRR, please try this link.